The reality of modern finance is it's almost magical, isn't it?
There really is.
You wake up and your entire financial life just seems to operate in the background, no manual input at all.
Mm-hmm.
Your paycheck, that direct deposit, has just appeared seamlessly in your account overnight. Your rent payment has been automatically transferred.
Right.
For so many of us, the idea of stepping inside a physical bank branch or even, touching a paper check is just, it's gone.
It's a thing of the past.
It's all instantaneous, invisible, and just overwhelmingly efficient.
It is magic, but it's a very highly engineered kind of magic. It's constructed on, decades of technological innovation.
And a whole lot of complex legal infrastructure.
Exactly. And while this level of convenience is phenomenal, it all rests on standards and systems that are surprisingly pretty rigid.
Okay.
This instant flow of money, what we could call the fully automated wallet, it also comes with some serious friction points.
Especially when the balance gets low.
That's it. And
Yep.
that forces us to look at the hidden costs of all this supposedly frictionless finance.
Exactly. We've gotten so used to the ease of tap and go, the instant transfer, that we rarely stop and, look under the hood.
We just take it for granted.
So our deep dive today is all about understanding the mechanics of this automated financial life. We're essentially asking, how does money actually move in the 21st century?
And what happens when that perfect digital flow hits reality?
Right.
Our source material for this deep dive gives us a fantastic blueprint for this. It lays out three really interconnected pillars of modern digital finance that we need to look at.
Okay, what are they?
First, we have direct deposit. That's the foundation. It's the main input for digital money, and it's been a massive driver of policy change.
Oh, the input.
Second, online banking. This is the entire global tech infrastructure. We can trace its history from old dial-up modems right up to the security protocols we rely on today.
And the third.
And finally, overdrafts. That's the major friction point.
Right.
It's where efficiency and automation can trigger consumer debt, and that's led to some huge regulatory and consumer battles all over the world.
So our mission is to trace the history, understand how these systems work, maybe contrast what's happening in the US and the UK.
And highlight the critical aha moments and some of the really controversial practices tied to each of these three elements.
Let's start right at the beginning then, with that foundational input, direct deposit. Operationally, what are we really talking about?
At its core, a direct deposit is, well, it's just a deposit of money from a payer directly into a payee's bank account.
And it's all done through an electronic funds transfer, an EFT.
Exactly. This is the mechanism businesses use for almost all recurring payments. Employee salaries, wages, payments to suppliers.
Big tax transfers, government benefits.
All of it.
So it sounds like a standard digital transaction, but in a system that's handling millions of these every single day, what's the one specific detail that makes it all work so smoothly?
The critical operational detail is the reference information.
The reference information.
This is what really separates a direct deposit from just a generic transfer. When the payer starts the EFT, they have to provide meaningful reference info.
So that could be like an account number or...
An invoice number, a policy number, or even just the payer's name clearly displayed. This seemingly small piece of data is absolutely essential for the person getting the money.
Why is it so important?
Because without it, trying to trace payments becomes a massive manual reconciliation nightmare.
Right.
Think about it. If a huge corporation deposits, say, $500,000 into a supplier's account,
The supplier needs to know what that's for.
instantly, they need to know accurately which 50 invoices that money covers. The reference data lets their automated accounting systems recognize the source and credit the money against the exact internal account or invoice.
So that's what keeps the whole flow truly automated and efficient.
It's the key.
But that system, it relies on everyone having a clear digital address, a bank account.
Good job.
And as soon as governments and big employers started standardizing on EFT, they hit a major societal problem that our sources get into.
What do you do about the unbanked population?
That's the paradox of mandatory digital efficiency, isn't it?
How so?
If a large payer, like a national government, is required by law to use electronic funds transfer, they have to, at the same time, create another electronic way to pay people who don't have a traditional bank account.
To make sure it's inclusive.
Right. Otherwise, that digital mandate immediately creates a barrier. It excludes people.
And the U.S. federal government is a perfect, huge case study of this exact problem.
Absolutely. The push started with a U.S. law passed back in 1996. It required the federal government to make electronic payments, mostly through direct deposit, available by 1999.
And that must have been a huge shift.
Monumental. It was all aimed at getting rid of the immense cost and, frankly, the security risk of mailing millions of physical checks for things like Social Security and veteran benefits.
So how did the government meet that mandate for the millions of people who were and still are unbanked? Well, they realized they couldn't just force people to open bank accounts. So instead, they engineered a specific public-private solution.
A partnership.
Yes. The U.S. Treasury Department teamed up with Comerica Bank and MasterCard. And together, in 2008, they launched the Direct Express Debit MasterCard.
The Direct Express card. Tell us about that. It's not a bank account, but it acts like one for getting paid.
Precisely. It's a dedicated prepaid debit card system. The key advantage is that it provides a practical electronic place for the funds to go. The government just routes the benefit payment directly to the card.
And that lets the Treasury meet its legal requirement?
It lets them comply with the electronic payment mandate while still offering a secure, low-cost, and accessible alternative to people, many of them elderly or low income, who either can't get or just choose not to use traditional banking.
So this conversation is really bigger than just technology. Direct deposit isn't just a feature, it's a foundational policy choice.
It is.
And one that requires the government to adapt to make sure everyone's included.
That is the critical analysis here. The development of direct deposit standardized the input flow of money. And that made all the subsequent digital banking infrastructure possible.
Right.
The very act of the government creating the Direct Express card shows that the move to EFT wasn't just about saving money. It was about establishing the bedrock for nearly all modern electronic transfers.
It cemented the digital movement of money as the default?
Exactly.
And the success of that standardization then allowed for the next big wave of change, giving all of us digital access to that standardized money flow wherever we happen to be.
Revolution.
Okay, so let's unpack that. From these automated standardized inputs, we get to the total digital infrastructure we have today. And it's genuinely hard for younger people to imagine a world without banking apps.
It is.
But the origins of online banking actually predate the internet by a long way. So how did we get here?
The history is surprisingly fragmented.
Yeah.
It's full of false starts. The concept we now call online banking actually started as distance banking over telephone lines.
And this was back in the 70s, early 80s?
That's right. And when people said online back then, they meant it literally. You were accessing the bank's central computer using a terminal, a keyboard, and a monitor, all connected through a phone line and a modem.
And the sources point to a pioneer in the U.S., but it's not where you'd expect. Not New York, not Silicon Valley.
No, Knoxville, Tennessee.
That's amazing.
That's one of those surprising details. The first home banking service offered to consumers in the U.S. was launched in December of 1980 by the United American Bank, or UAB, in Knoxville.
And what made their approach special?
They went the custom tech route. They actually partnered with Radio Shack to develop a custom secure modem specifically for the popular TRS-80 computer.
Wow. A bank and a consumer electronics store. That tells you how cutting edge this really was.
It was.
What did you get for your money back then? What could you do?
Well, customers were charged a pretty hefty sum for the time, about $25 to $30 a month.
Wow.
But the services were surprisingly comprehensive. They went way beyond just finance. Oh, yeah. They included the expected stuff. Bill pay, loan applications, balance checks.
Yeah.
But UAB saw this as a total digital platform. So they also offered game access, budget and tax calculators, and even digital access to daily newspapers.
They were trying to be the complete digital hub for the home.
Way ahead of their time.
A financial platform bundled with entertainment and information. That's a direct precursor to what we're seeing with neobanks today.
It is.
But this U.S. innovation stalled almost as soon as it started, didn't it?
It did, for a few reasons.
Yeah.
Right after UAB pioneered this, the big New York banks, Citibank, Chase, they followed in 1981, but they bet on a different system, a standardized one called videotex.
And that didn't work out.
No. That expensive videotex infrastructure largely failed commercially in the U.S. Consumers just weren't ready to pay for that kind of dedicated digital access.
And to make matters worse, the original pioneer, UAB, failed too.
Yes, and this is where financial integrity, or a lack of it, really undermined the technology. United American Bank failed in 1983, not because of bad tech, but because of massive loan fraud run by the bank's owner, Jake Butcher.
Oh, wow.
So when another bank, First Tennessee, acquired the failed institution, they made a strategic call not to pursue or commercialize UAB's groundbreaking computer banking platform.
So U.S. adoption gets set back by a failed tech standard and a major financial scandal that probably destroyed public trust in the whole idea.
That's a perfect summary.
So while the U.S. was stalling, how did Europe manage to get these early systems to work?
Europe found success because they solved the distribution problem. In the UK, the Nottingham Building Society, or MBS, launched a service called Homelink in 1982.
Homelink, quick.
They used British Telecom's Bristol system, and they connected a computer, often it was the affordable BBC Micro or just a simple keyboard terminal, directly to a television set.
And what made Homelink a success where the American systems failed?
It was just comprehensive and practical. You could arrange loans, compare prices, order goods from major retailers, check real estate listings.
And the important stuff, transfer money and pay bills.
Exactly. Now, at first, they still required written instructions to set up a new person to pay, but they quickly adopted the BACS system for direct electronic payments. It got to a national scale really quickly. It was a real working system while U.S. banks were still just experimenting.
And France took this idea to a whole other level with Minitel.
France is the absolute exception to the rule that videotex failed. They launched their first videotex banking service in 1983, and crucially, the French government subsidized it.
How?
They gave away millions of Minitel terminals for free to the public as a replacement for phone books.
That's brilliant.
This mass distribution meant videotex banking just flourished. It got to an impressive 19% market share in France by 1991. The lesson is pretty clear. If you standardize the hardware and make access free, people will use the service.
Incredible. So the tech itself wasn't the problem, it was the distribution model and the political will to back it.
Exactly.
And then, of course, the real game changer arrives in the mid-90s, the World Wide Web.
Right. The internet instantly solved that proprietary hardware problem.
And Wells Fargo was first in the U.S.
In 1995, Wells Fargo was the first U.S. bank to integrate account services into its public website, and another bank, Presidential, was the first to let you open an account entirely online.
But the data shows that customer adoption was just agonizingly slow at first. Why the lag?
There was still just immense public skepticism. I mean, the data shows that by the end of 1999, less than half of 1% of U.S. households were using online banking.
Wow, less than 0.5%.
This was not an overnight revolution. It was a gradual evolution based on trust and just getting familiar with the technology. You see it in the big banks. It took Bank of America a full decade, from 1995 to 2005, to get its first 2 million e-banking customers.
Given that slow start, why did banks see this clicks and bricks model as so strategically important?
The internal economic drivers were just irresistible. Web-based banking dramatically lowered transaction costs compared to running physical branches and paying tellers.
And it made it easier to roll out new products.
For sure. And crucially, banks quickly figured out that online customers were way more loyal and more profitable than their branch-only counterparts. By the early 2000s, Bank of America knew its online customers were doing billions of dollars in electronic bill payments. The efficiency gain was massive.
And that realization is what directly led to the rise of the pure digital model.
Absolutely. The early 2000s saw the first wave of direct banks, or as we'd call them now, neobanks.
The ones with no branches at all.
Right. They cut the cord completely, operating exclusively on lawn or over the phone. Their big advantage was lower overhead, so they could offer better interest rates or lower fees.
And that's the 40-year journey, from custom modems in the 80s to today's completely branchless banks.
A 40-year outcome of standardizing the digital flow of money.
Now that we've mapped out the history and the infrastructure, we have to look really closely at the operational system itself.
Right.
Because while online banking gets rid of the friction of physically going somewhere, it introduces these intense security requirements.
An immense reputational risk for the banks.
Security is everything. So let's start with the basics. What are the operational layers a customer needs to get through to access their funds securely?
Okay, so functionally, a customer first has to register and set up strong credentials. Then they access the bank's secure site through a browser or an app.
And the basic services are viewing balances, transactions, paying bills.
Right, and transfers. And crucially, all financial institutions apply explicit and often adjustable limits on how much you can transact. That's a primary built-in defense to limit potential fraud loss.
What about the more advanced stuff?
Modern systems are all built for integration. So they support sophisticated features like importing your transaction data directly into accounting software. And we're also seeing the rise of account aggregation. That allows a customer, through a single interface to see all their accounts, even if they're at different banks.
And that convenience is totally dependent on trusting that the security underneath is just impenetrable.
100%.
So let's talk about those security mechanisms. A single password is obviously not enough. Globally, what was the first big step towards multi-factor authentication, or MFA, in banking?
The standard that was widely adopted, especially in Europe, was the PIN-TAN system.
PIN-TAN.
The PIN is your personal identification number. That's for login. The TAN, that's a transaction authentication number, acts as a one-time password used specifically to authenticate a transaction.
So even if someone steals your login, they can't actually move money.
Exactly. They can't execute the transaction without that second factor.
And how did the way we get those TANs evolve to fight back against more sophisticated fraud?
Well, they moved from static pre-printed lists of TANs that the bank would mail you.
Which could be stolen.
Easily. They moved to dynamic on-demand methods. The first big step was the SMS TAN system, where the transaction details and a unique short-lived TAN were sent to your mobile phone.
And that lets you cross-check the details on your phone against what you think you typed on the computer.
Exactly. Similarly, you saw photo TAN, or QR code-based systems emerge, where you use a physical reader or an app to scan a code and generate the specific TAN.
But even SMS TANs were vulnerable to really sophisticated malware, right? So what's the most robust system the sources talk about?
That would be the chip TAN system. It was designed specifically to counter the most insidious type of attack.
Okay.
The key innovation is that the verification device, it's a small reader you stick your debit card into, is physically separate from the computer.
So it has its own secure channel.
Right. When you start a transfer, the transaction data, including the recipient's account and the exact amount, is sent to the chip TAN generator through a visual stimulus, usually a flashing graphic on the screen.
And you confirm it on the reader itself?
You see it and confirm it on the reader's own small secure screen before the TAN is generated.
So the key takeaway for you, the listener, is that the verification step is moved completely off the potentially infected PC.
Precisely. It eliminates the risk of malware on your computer messing with the data because you are verifying the amount and destination on a trusted, separate piece of hardware.
Which brings us to the threat landscape. What are these multi-layered systems actually defending against?
The attacker's primary goal is always the same: deceive the user to steal their login data and valid TANs.
Right.
The threats range from broad social engineering like phishing and farming,
Where they mimic a bank website?
to highly technical malware injections like cross-site scripting and the really dreaded man-in-the-browser attack.
Okay, explain the man-in-the-browser attack again, because that sounds like a masterclass in deception, even for someone who knows what they're doing.
It is insidious because it operates locally on the victim's machine, and it's often completely undetected by antivirus software.
Just how does it work?
Malware secretly injects itself into the web browser. So when you log in to your bank and enter the correct transfer details, say you're sending $500 to your sister,
Okay.
the malware secretly changes the destination account number and the amount in the browser's memory before that data is encrypted and sent to the bank.
So you see the right data on your screen, but the bank gets the manipulated data.
Exactly. The bank receives instructions to send $5,000 to the fraudster.
But if you check the URL and you see the little secure lock icon, how does it still trick the system?
Because the compromise happens after the secure connection is established and before the data leaves your PC, that little lock only confirms a secure connection between your browser and the bank. The malware is operating inside the browser application itself.
The stakes are so high.
Incredibly high. The data showed online banking fraud in the UK doubled between 2011 and 2017. And that put immense pressure on regulators to mandate stronger protections.
So what were the key regulatory responses to this?
In the U.S., the Federal Financial Institutions Examination Council was actually ahead of the curve. They issued guidance in 2001 and then required all federally supervised banks to have multi-factor authentication, MFA, fully in place by the end of 2006.
And in Europe, the regulatory philosophy kind of shifted to a stance of permanent distrust, didn't it?
That's a great way to put it. The 2012 advice from the EU Agency for Network and Information Security was crucial. They basically told banks to operate under the assumption that the user's PC is infected with malware by default.
Assume compromise.
Exactly. And that necessity led to prioritizing security processes like SMS TAN and especially chip TAN systems, where the user is forced to verify transaction data on an external trusted device. It reinforces that the desktop itself just can't be trusted for verification anymore.
We've covered the mechanics of efficiency, the layers of security, but all of that convenience is built on an assumption of universal access.
Yeah.
And now we have to talk about the fact that this highly engineered digital system starts to fail human beings. It has a significant human cost, the consequences of the digital divide.
That's right. The widespread adoption of online banking, while good for many, has been directly correlated with aggressive bank branch closures and reduced retail operating hours.
And when you strip away that physical infrastructure,
It creates systemic discrimination against groups who cannot or will not use online services.
and who are the most vulnerable people in this shift?
Primarily the elderly, individuals with certain disabilities, and people living in areas without reliable high-speed broadband.
Right.
These are citizens who often prefer or even rely on face-to-face interactions to manage their finances, get advice, or just access their funds without needing technology. When the last branch in a small town closes, their access can just disappear entirely.
We saw this frustration explode into a huge public outcry in Spain just a couple years ago.
That Spanish anecdote from 2022 is incredibly powerful. A retired Spanish urologist who also suffers from Parkinson's disease, he launched an online petition protesting this exact kind of exclusion.
And it got a lot of traction.
Massive. It gathered over 600,000 signatures. The core of his complaint was that the elderly and the most vulnerable were being pushed aside, forced to queue outside bank branches, only to be pressured to use ATMs or mobile apps they just struggled with.
What was the trigger for this specific action? What was happening in Spain?
Well, the Spanish banking system, after a major bailout in 2012 and then accelerated by the pandemic, had gone through this aggressive consolidation. Thousands of federal branches were closed.
And the protests brought that to light.
It successfully highlighted how this mandatory digital efficiency had been achieved at the expense of basic human accessibility.
And the industry's response shows that public pressure can still force change.
It did. The Spanish Banking Association responded by signing a protocol, committing to tangible improvements for senior citizens.
Like what?
They pledged to extend counter-service hours, make sure that older clients are prioritized, and crucially, simplify the interfaces of their apps and websites to be less complex. It was a formal admission that access has to be universal, regardless of your tech, literacy, or physical ability.
Now, beyond physical access, there's a second major criticism of automated finance, the issue of algorithmic fairness.
And this raises a profound ethical and regulatory challenge.
How so?
When financial decision-making, whether it's getting a loan, a credit risk assessment, even just account maintenance, is managed by these complex proprietary algorithms, it creates opacity. It makes it incredibly difficult, sometimes impossible, for a consumer or a regulator to pinpoint discrimination, like race or gender bias.
Because it's all hidden inside a black box.
Exactly.
So just like we recognize that the Direct Express card was necessary to ensure inclusion,
Right.
we are now recognizing that reliable, equitable broadband access is the next crucial piece of infrastructure.
Absolutely. The need for equitable access to digital services is now a matter of national policy. The U.S. Federal Communications Commission, the FCC, formed a task force in March of 22 specifically to prevent digital discrimination.
Recognizing that without broadband, you're locked out.
They recognize that without robust, affordable, and accessible broadband, citizens are effectively blocked from participating fully in the modern financial system. Broadband is no longer a luxury, it's a foundational necessity for financial inclusion.
We've traced the secure input, the secure infrastructure. Now we shift to the inevitable friction point, overdrafts.
Right. This is the moment money leaves the account in excess of the available balance. And as you said, this concept is ancient. It predates most modern financial institutions.
300 years old, starting with the Royal Bank of Scotland. Take us back to 1728. Who was the first customer and what problem was this solving?
The recipient was a merchant named William Hogg. And like many businesses back then, Hogg had cash flow timing issues. He needed to pay his debts now, but he wouldn't get paid for what he'd sold until later.
A classic problem.
So Hogg came to an agreement with the new Royal Bank of Scotland that allowed him to overdraw his account. It was essentially a short-term, pre-agreed loan against an empty balance.
So it was an innovation for trade and liquidity, not a consumer penalty.
Precisely. It
Yeah.
was a fundamental invention for commerce. The philosopher David Hume saw this almost immediately. He described the cash credit system in his essays as One of the most ingenious ideas that has been executed in commerce.
It provided the liquidity to get the industrial economy moving.
It did.
Okay, let's fast forward to the modern automated wallet. Why do accounts go negative today? Our sources give a whole taxonomy of reasons, starting on the consumer side.
Right. The reasons fall into a few distinct buckets. First, you have customer error or intent.
Okay?
This includes the intentional loan.
Yeah.
You're making a debit and expect to cover it soon. It includes simple negligence in record keeping where you just lose track.
Or what they call playing the float.
Or playing the float, hoping a deposit clears before a debit hits and causes an overdraft.
Is playing the float just trying to cheat the system? I mean, where's the line between that and just simple negligence?
It's a gray area. Usually it starts as negligence with a side of optimism. The customer knows they're cutting it close, and they're relying on a deposit posting at a specific time.
And if it's late, you're overdrawn.
Right. But when this happens with a deposited check that then gets returned for non-sufficient funds, what we call check kiting, that quickly crosses the line into intentional fraud.
Got it. Okay, what about the systemic issues, where the money is technically there, but the banking rules make it unavailable?
This is a huge area of consumer friction. The most common is temporary deposit holds.
Right.
In the U.S., for example, Regulation CC dictates how quickly banks have to make funds available. If you deposit a check, the bank can place a hold on it. The funds aren't immediately available for you to use, even though they might appear in your balance.
And if a payment hits while the funds are on hold,
It can trigger an overdraft.
and then there's the even trickier issue, authorization holds. Walk us through that trap with a simple example.
Okay, imagine you use your debit card at a gas station or a hotel. You swipe the card, but instead of using your PIN, you run it as a credit transaction.
Right.
The bank immediately places an authorization hold on your account, let's say for $50, to make sure the funds are there.
But the merchant might not collect the final actual amount, say $45,
Right.
for several days.
Exactly. And sometimes the bank releases that initial $50 hold before the $45 transaction actually clears.
Oh, I see.
So the customer sees the $50 is released, assumes they have that money back, and they spend it. Then 2 days later, the merchant collects the actual $45, and if the balance is now low, boom, the account instantly overdraws.
You get a surprise fee triggered by a transaction you thought you paid for days ago.
This mismatch between the hold and the final settlement creates an artificial overdraft opportunity.
Uh-huh.
It is exactly the kind of technical opacity that drives consumers crazy.
Absolutely. And the last category.
Finally, we have fraud or external issues. This is things like a return check deposit. A check you deposited gets charged back, creating an instant negative balance plus a fee. And of course, direct victimization through identity theft or phishing can also lead to overdrafts.
Let's shift to regulatory action, starting with the UK, which did a massive overhaul of its overdraft system in 2020. What was the core structure they were trying to fix?
Before 2020, the UK system really relied on the difference between arranged overdrafts, where you had an agreed limit with reasonable fees, and unauthorized overdrafts.
And that's where the bank just informally covers a payment that goes over your limit.
Right. And if the bank covered it, the fees and interest rates were often exorbitant. If they declined it, they charged you a fee for the refusal itself.
And what was the specific controversy that made them reform it?
It was the egregious practice of excessive fees compared to the bank's actual cost, and how those fees compounded. A BBC investigation highlighted that before April 2020, fees for an informal overdraft could hit £25 or £30 per transaction.
Even though the bank's actual cost was what?
Estimated at less than £2. But the most contentious part was the fees on fees trap.
Fees on fees.
A bank would decline a payment, charge you a refusal fee, and that refusal fee would then cause your balance to go negative, which triggered a second additional fee for being overdrawn.
The punishment for being overdrawn was literally creating more debt and more punishment.
Exactly. This predatory structure led the Financial Conduct Authority, the FCA, to announce sweeping reforms in 2019, which took effect in April 2020. The goal was to reclassify the overdraft from a penalty back into a standardized regulated loan.
And what were the key mandates of that reform?
4 major changes. First, arranged and unarranged overdraft rates had to be the same. Banks couldn't charge wildly different rates anymore.
Okay.
Second, they had to end daily charges and present the cost as a single, clear annual percentage rate, an APR. Third, refused payment fees had to be brought in line with the actual minimal cost to the bank.
And the fourth?
And finally, banks were required to actively intervene to identify customers in financial difficulty and work with them to reduce their overdraft usage. It was a massive victory for consumer clarity.
That UK reform standardized the loan structure, but in the US, the controversy often focuses more on subtle maneuvers and how banks market their protection plans, and it starts before you even open an account.
It does. The U.S. system uses these specialized consumer reporting agencies to track checking account behavior, agencies like check systems or early warning services.
And they track things like chronic overdrafts.
Chronic overdrafts, accounts closed with negative balances, things like that. And they calculate what's called a debit score.
And what are the consequences of a low debit score?
Well, if you have a poor history managing your checking account, banks can use that low score as justification to deny you a new checking account altogether. They're trying to proactively avoid the risk of a high-cost customer.
Let's talk about how U.S. overdraft protection evolved. It used to be a human decision.
Historically, yeah, it was based on ad hoc coverage. A local bank manager would review the daily list of accounts about to overdraw.
And if you were a good customer,
They might use their discretion to pay the item without a fee, a genuine service. But with the shift to huge, automated interstate banking, that traditional human discretion is almost entirely gone. It's been replaced by automated, rigid systems.
which brings us to the three main categories of modern U.S. protection. The first are the true regulated loans.
That's the contractual loans category. This includes overdraft lines of credit, which require a formal application and a credit check.
And because the bank promises to cover it, it's regulated under the Truth in Lending Act.
Right, which means clear disclosures. The other type is linked accounts, where the bank automatically moves money from a savings account or credit card to cover the shortfall.
And then the third type, the Bounce Protection Plan, is the most contentious one because it operates in a legal gray area.
It is the most controversial. Bounce protection plans are automated, discretionary programs. The bank decides whether to pay the overdrawn item based on objective criteria, your average balance, your account history.
But here's the crucial legal distinction.
The bank offers no contractual promise to pay the overdraft. They explicitly reserve the right to refuse.
And because it's discretionary, not a guaranteed loan, what happens from a regulatory perspective?
Well, critics argue that the bank advances funds and expects repayment, which makes it a loan in practice. But that discretionary clause lets them sidestep the disclosure requirements of the Truth in Lending Act.
So they charge these steep fees for each overdraft, plus daily fees, without the same level of disclosure.
Exactly. It makes it a costly debt trap for vulnerable customers.
And this friction point led to the biggest consumer legal battles in the U.S., the transaction processing order. How did banks use that to artificially maximize fees?
This is a textbook example of financial engineering for profit. Many large U.S. banks adopted the practice of processing debits from largest to smallest, the biggest check-first policy.
Okay, let's use that $100 balance example again. If I have $100 and I make four $20 purchases and $150 purchase, why does the order matter so much?
Okay, if the bank processes the four small $20 transactions first, your account balance stays positive until the last one clears. The $150 purchase will overdraw the account by $70, triggering one overdraft fee.
Just one.
But if they execute the $150 transaction first, your account immediately goes negative by $50. Now, the four subsequent $20 transactions all hit a negative balance.
Turning them into four separate overdraft events.
Right. You suddenly get 5 separate overdraft fees instead of just one.
That is structural manipulation designed only to trigger multiple fees. What was the bank's defense in court?
They argued that processing the largest item first ensured that your most critical payments, like rent or a mortgage, were always paid.
But consumer groups challenged that.
Successfully. They challenged it under state deceptive practice laws, arguing the intent was plainly manipulative. And this led to massive settlements. U.S. Bank, for example, paid a $55 million settlement in 2014 over this exact practice.
So the U.S. government had to step in with specific consumer protections.
They did, specifically for debit card and ATM use. In July 2010, the Federal Reserve revised Regulation E.
And what did that do?
It required banks to get explicit customer consent and opt in for overdraft protection on one-time debit card and ATM transactions. If you didn't opt in, the transaction would just be declined at the register. No fee.
That sounds like a clear consumer win. Did it actually reduce the fees customers paid?
The results were paradoxical. It provided clarity, yes, but the customers who chose to opt in paid substantially more.
How much more?
Research showed that opted-in customers paid an average of almost $260 in fees per year.
Wow. And yet, surprisingly, the study showed that up to 90% of customers still chose to opt in.
A staggering number.
Why would nearly 90% of people knowingly opt into a service that costs them hundreds of dollars a year?
It really speaks to the power of convenience and cognitive bias. For many people, avoiding the embarrassment of a declined card at checkout or just having that safety net for cash withdrawals was worth the high potential cost.
They valued the uninterrupted flow over the long-term savings.
Exactly. And that reliance on convenience, even at high cost, has ensured that U.S. banks continue to post enormous profits from overdraft fees even after the regulation.
Given all that complexity and cost, it makes sense that new fintech alternatives are now actively trying to solve this problem.
Absolutely. We are seeing innovative apps and dedicated fintech services pop up, offering small, zero-interest advances or fee-free short-term liquidity. They're directly challenging the high-cost, automated complexity of the traditional bank overdraft systems.
And they're succeeding by offering simplicity and transparency.
The very things the major banks have struggled to provide.
This has been a fascinating journey. We've tracked the evolution of finance from, the paper check era to our current fully automated wallet.
Right.
We started with the necessity of electronic funds transfer through direct deposit, recognizing it as a foundational policy choice that created the input for the whole digital system.
We then explored the bumpy history of online banking, from the initial failures of proprietary U.S. tech in the 80s to the successful global internet rollout, and then the development of these sophisticated external security measures like ChipTan.
Which are mandated by regulators who have to assume your computer's always compromised.
Right.
And finally, we unpacked that friction point of overdrafts, contrasting the consumer-focused UK regulatory shift.
Which forced banks to standardize fees into a clear APR loan model.
With the ongoing U.S. battles over transaction ordering and the high cost of that opt-in discretionary protection model.
And what this entire deep dive really highlights is the core transformation in modern finance, the decisive removal of human discretion.
How do you mean?
The old system, the local bank manager deciding whether to pay an overdraft for a trusted customer, that's been replaced. The new, fully automated system, whether it's bounce protection or algorithmic fee structures, is objective, rigid, and ultimately far less forgiving than the discretionary manager of the past.
It's a trade-off. We gained incredible speed and convenience, but the mechanisms of access, of debt, and decision-making have become incredibly complex and often hidden behind the screen.
Making the automated wallet a constant subject of regulatory review.
And that leads us to our final provocative thought for you, the listener, as you navigate your own automated financial life.
We learned that the early online banking pioneers, like the United American Bank in 1980, didn't just offer banking. They bundled financial services with entertainment, like games and information, like daily newspapers. They were trying to be a central life platform.
Right.
As modern digital banking platforms continue to integrate services like personal financial management and account aggregation, and as their algorithms deepen their knowledge of your precise spending habits, your health status, your creditworthiness, consider this.
What valuable personalized services currently entirely outside of traditional finance will be the next thing they seamlessly integrate into your digital banking experience? Where does the line between your bank and your total life platform finally disappear?